Hey, everybody. This is Johnathan Rankin, and we are here live for Retirement Intel. It is Tuesday, and it is 4 p.m. Central Time, so we are live. Let's go ahead and do this today. We've got a great show for you today. I'm going to be digging through 10 wealth principles to help you achieve financial freedom. And really where this came from was I've been asked over the next couple of days to speak in front of a group of people about just wealth management, financial planning, and the overall keys to financial success. And so, I was asked to put together just some thoughts around what are some of the top principles or top things that someone should pay attention to when trying to build their long-term financial net worth and their financial well-being. So I put those together. We're going to go through the 10 wealth principles to help you achieve financial success and financial freedom. So we'll go ahead and dig right in here. So the first one that we'll touch on is, if it sounds too good to be true, it probably is. Now, I know that this might sound elementary, might sound like something that you may have heard before, but when it comes to financial planning, financial investments, this is absolutely true. And as you can see, I put there, especially with insurance products. This is something that if you're planning on your retirement and it's something that you're focused on, you've probably at some point, you either have been or will be at some point told that you should buy some sort of insurance product. And it's going to sound fantastic. It's going to have so many different bells and whistles to it. It's going to have all these guarantees with no loss and all this upside. And it's going to sound like the perfect investment. And it's always perfect until it's not. And that's where you've really got to think about, okay, what does perfect for you look like? And so when you're thinking about investing for retirement or really anything, there is no, one investment is the best investment. There's no one size fits all for everybody. And so what we typically see, especially for the clients that we work with, is that at some point they've been, propositioned with some sort of insurance product. And I will tell you, this isn't to pick on insurance. It's not like it's a bad thing. There's a place and a need for it. But any investment, whether it's insurance or otherwise, if it sounds too good to be true, it probably is. And so when you're thinking about building out your portfolio for your retirement and your long-term, financial success and financial freedom, keep that in mind, because whether it's, lately it's been AI tech stocks. I guarantee you, a lot of people back in 1998, 1999 were probably thinking the exact same thing at the time, that, hey, these investments, these stocks that were going crazy during the dot-com bubble, best thing you could have ever done. I remember back in 2007, 2006, where you couldn't do anything without, people talking about getting a new home and flipping it. I remember the show, and some of those that are watching probably remember Flip This House. Remember that show where we all thought, hey, you know what? This is going to be easy. Let's just go out. Let's buy some home. Let's put a little work into it, and then we're going to flip it, and then we're going to make a bunch of money. They even did shows about this. So anything in the investment world, if it sounds too good to be true, be wary about it. Ask a lot of questions. Make sure that, if it's something that you're going to be investing in, that you're putting, and you're factoring that into your financial plan. That's extremely important, when it comes to anything that's got liquidity risk. And so when I think about insurance products or, real estate or private deals or anything like that, you want to know what the liquidity is. You want to know when you can access your money. So just something to keep in mind. That is the first principle that I think is important to understand when you're working towards financial success. So the second one, avoid advice from anyone who says one of the followings: 401ks are a scam. The mention of any product, any singular product, they use the quote, "It's a secret the wealthy use," or that you need some sort of leverage. To me, those are four things that if anybody says those things, just run. I think I've talked about it before on this show, and if you've been following us along for a while, one, thank you. If you're new here, make sure you hit that subscribe button. But I talked about this before. Anybody who says, that 401ks are a scam, just politely go the other way. There's a reason why there's trillions and trillions of dollars in these vehicles, because they help people save for retirement. Are they the only way you can save for retirement? No, absolutely not. Are they a simple way that you can save for retirement? Absolutely. But anybody who says the words, that that's a secret that the wealthy use, or that they're talking about any one singular product, that they're just wrong. There is no secret that just the wealthy use and the wealthy know, because I'm gonna be honest with you, a lot of people who are wealthy don't really feel like they're wealthy, and they're using a lot of different strategies that are available to anybody. So just keep that in mind. The last one there, that you need some sort of leverage. I bring this up because, especially now that interest rates are coming, supposed to be coming down. Tomorrow the Fed's looking to reduce rates for the first time since 2022. And so now that rates are likely to come down, you're going to hear a lot of talk about refis are back on the table. You can take money out and you can put that into, into the markets. And, I remember when I first got in this business back in early 2007, and there was, an individual that was in the same office I was, and he was trying to tell all of the new people like myself, here's what you need to do. You need to tell people they can take money out of their appreciated home and put it in this portfolio, because this portfolio has done so well. Well, this was in 2007. And we all remember what happened in 08 and 09. And I think about those people that, this individual did that with, where they took money out of their house that was a depreciating asset at that time, for going through 2008, 2009. They put it into the markets, which at the time was also a depreciating asset that fell in 2008 by 38%, and then in the beginning of 2009 was also down. So from peak to trough, it was down well over 45%. Those people, that was a really, really hard time and a hard thing to go through. So anybody tells you that you need leverage, or you need to some sort of debt, or to use someone else's money, just make sure that you're focusing on what your financial goals are, and not taking some advice that's going to expose you to a lot more risk. If you're comfortable with that level of risk, fine, but just keep that in mind as you're building out your own retirement picture. All right, so jumping to number 3 here. This is my favorite. The news is there to monetize your fear. This is important because where you get information from is one thing, where you get advice from is another thing. They're two separate things, and you should be thinking about that as you're listening to any sort of medium out there. And to be honest, myself included, if for some reason, I don't want anybody to take anything that I say on here as specific financial advice. This is generalized financial advice. If you have questions about your specific circumstances, we'd be happy as a team and as a firm to dive into your specific circumstances. But anybody who's telling you that this is a stock you got to buy, or this investment over here you've got to do, it's really based out of some sort of ulterior motive, especially on the news side. Now that we're getting close to the election, my guess is that there's a ton of coverage out there on how the election is going to impact the markets. And guess what? We've got a webinar coming up. It's coming out on the 23rd. So next Monday, if you haven't already registered, make sure you do that. The link is in the description below. Register for that webinar, where we've gotten economists coming out talking about the election impact on the markets. Now, our goal is to just deliver the information in that setting. The advice comes on a one-on-one basis. And so when you think about where you're listening to on a daily basis, whether it's CNBC or Fox News or CNN or wherever you're listening to, their job is to make sure that you stay tuned in to what they're doing. And I always think about this, going back to 2008. Every time we go through any sort of down market, all they ever talk about is that the market's going to keep going lower, because the goal is to keep you locked into that channel. So just always keep that in mind as you're focusing on your financial goals. Dive into number 4 here. Concentration is the greatest way to build and to lose wealth. So this is important. It's important to understand the risks that you're taking. Yes, concentration in any particular investment. And a lot of people don't think about it, but your business, if you're a business owner, that is concentration into a single business. If you've got one individual stock in your portfolio, It's concentration into another singular business. So concentration is a great way to build wealth. That's how a lot of business owners eventually they build their business. They exit, whether that's from selling it or going public or you name it, they exit that business somehow. And that's how they create their wealth for their family and for themselves. Now, it's also a way to lose a lot of wealth. And this goes back to the risk side of it. Especially right now, over the past year and a half, we've seen a lot of, a very handful of individual stocks really lead the market. And it always causes this rush to, overweight and become concentrated in a certain area. And it's a great way to build wealth. But as I mentioned earlier, people back in 2000 and 1999, they remember what it was like if they were concentrated in the .com names back in 2006, 2007. Those that were concentrated in real estate remember exactly what that ride felt like. I'm not saying everything has to come to an end. Concentration can be used if you've got a business, as I mentioned, and you sell that business. But just keep in mind the risks that you're taking and factor that into your overall plan. What if it does go south? So, a lot of people think concentration is a bad thing. It doesn't have to be if it's something that you're okay with, you understand the risks, and it's something that you're building into your financial plan and you're confident in. If you're confident in it and it's, let's say, your individual small business and you know that you're growing it, you're working it day in and day out, great. But just remember that at some point, you can either create a lot of wealth or it could lose a lot of wealth. It's just important to understand the risks there. All right, so number 5, outsourcing is money well spent. This is where I look at, for people who generated an amount of wealth, they're at the point where their time is very finite. At a certain point, I know myself personally, I don't want to change my own oil. I don't want to mow my own lawn. And now that's not because I can't do those things. Well, okay, let me take that back. I don't think I can change my own oil, but I can definitely mow my own lawn, but I don't want to. Time is finite. And so the amount of money that you pay to, whether it's a CPA or an attorney or an advisor or just a professional in general, is well worth it. And that's the one thing that I've learned with working with people for, the past 18 years is that, once people accumulate a certain amount of wealth, it's truly about making sure they can maximize their time. And I've never seen people that, ever regret how much they're spending on outsourcing services and advice, because it gives them time to, spend time with the people they love, doing the things they love. So as you're thinking about your financial freedom, part of that financial freedom is not to worry about it and deal with it on a day-to-day basis. And that's where outsourcing can be a huge benefit, not just on the advisory or investment side, but also the tax side or, the attorney side. ChatGPT right now, great for a lot of general ideas, probably not going to be the place where you want to go to help you do your taxes. So just keep that in mind as you're building out your portfolio. Next part of it, complicated doesn't mean better. Now, this principle I put in here, and as I mentioned, I'm going to be speaking to a group of individuals that are younger, that are focused, they're medical professionals focused on building, their long-term financial freedom. And this is one of the principles that I think is important, and as I've gone through my career that I've shared with a lot of clients, is that, there are so many different strategies and investments that are out there that might sound so good, and they're going to be, they're going to sound like the smartest thing ever, or they're going to be so complicated that, the person on the other side of the table doesn't even understand what this product is. But that doesn't necessarily mean it's better. A lot of the times, being simple in your investment strategies can help you feel more confident when the market goes south. It can help you feel better about just understanding what it is you own and why you own it. So if you're presented with investments that are overly complicated, make sure you ask questions about it. Make sure that if there's anything in your portfolio that you have any doubts over or any questions on, it's important that you understand what they are, how they work, because ultimately, when we go through any sort of volatility in the market, everybody pulls up their statement or logs online and they look at their balances and their accounts. And when you start seeing those red numbers, the first question that comes to mind is, why am I losing money? And what is this? Or maybe flip-flop. What is this and why is it losing money? And so you want to be able to know without a doubt Okay, I know that this fund is, or this investment is, large cap growth, and I know why it's down. Or this is a real estate investment. I know why it's down. But don't ever, you don't want to be caught with, seeing something during a down period and go, I have no clue what that is. I don't know why it's in my portfolio. I don't understand how it works, but it's in there somehow. So as you're building out that portfolio, just make sure that it's important when you open up your statement. If you have any questions about what you own and why you own it, make sure you're asking those questions. And it's important to do that now. The market is, near all-time highs. We're not in a 2008 or 2022 timeframe where the market's sold off by 15 or 20%. We're not there yet. This is now the time where if you're going to make any changes, now is the time to do it. The last thing you want to do is make all these asset allocation changes and investment changes after the market's fallen. If you feel like you don't understand something, ask those questions now. Feel confident about your portfolio going into the storm. Don't try to patch it up, as the rain's falling and figuring out, okay, do I need to plug one hole over here and patch something over there? Understand it now so you can feel confident going into any sort of volatile period of the markets that, I know what I've got. It might go down, but I feel confident in it. And that's the important part. When going through, a period like 2008, I think about, some of the large cap, mega cap companies that, people at the time, they felt comfortable owning, and it doesn't mean they didn't go down. I mean, we look back at 2022, the most recent bear market we had. Doesn't mean that some of these companies didn't go down. Apple went down that year, but I know that they also sell billions of iPhones and they sell billions of iPads. And I know that right now, as I look at my setup, I've got an iPad, I've got a Mac, I've got an iPhone somewhere. It's not necessarily that it's always going to go up or stay flat, but you feel confident in what you own. So just, try not to overcomplicate your investments. It's really important as you go through and building out your long-term financial plan and your financial investment strategy that you feel good about what you own. So let's go ahead and dig into the next principle here. If you have questions, if you're joining us live, feel free to use that chat button. Say hi. Love to chat with you. We're here every Tuesday, 4 p.m. Central. So hopefully you're a regular that's joining us. But if you have questions as we're going through any of this stuff, or there's just something that's on your mind, share it. Love to hear from you. All right, number 7. This is my favorite, especially with retirement planning. Nobody knows what enough money is. So if you're planning on retirement or you're thinking about retiring at some point, and you just start thinking to yourself, I don't really know how much I need to retire. Guess what? You're not alone. You are absolutely not alone. Most people, when I first talk to them and I ask them, so when would you like to retire? They have an age in mind. They think, you know what? I would love to retire at 62, 65, fill in the blank. Okay, next question. Do you have any idea how much you actually want to spend or that you're going to need to live off of in retirement? I would say 95% of the time, most people go, I have no clue. Because most people don't know the number. They know the feeling. They know what they want to accomplish. They want to be able to step out of work and just go into retirement and not have to worry about money. The rest is all, the planning side of it. It's important. Yes, you've got to eventually get to the number, but no one knows off the bat what it is. These rules of thumb are, you need to have 80% of your pre-retirement income, or I've seen as low as 70%, as high as 90. Those are all great in theory. That's great for just back of the napkin math that you can do. But if you're really focused on, building out your long-term retirement goal, my guess it probably started without knowing specifically how much you want. And I just want you to know that you're not alone. Most people have a hard time knowing what they're going to be spending, next month, next year, let alone 5 years from now and for the next 25 years. So there's always going to be that question, and that's where planning comes in. Now, the goal with retirement planning is that you first start out by saying, what's possible? How much money can I live off of? Is there, with all the savings, all the streams of income that I've accumulated over the past 20, 30, 40 years of work experience, I've accumulated all these assets. What is that going to actually do for me? And then that's going to generate a certain amount of income at some point, whether that's portfolio withdrawals, income from, whether it's rental properties or Social Security or a pension. It's going to have some sort of income that you're safely able to generate. And then you're going to look at it and go, either the A, hey, that sounds good, I think I can live off that, or B, I don't think that's enough. And then you get to start understanding your budget more and tweaking things a little bit more. But very rarely, very, very rarely, and usually only, my engineer clients that will know exactly to the penny, here's what I spend every single month, and here's exactly what I need when I retire. Most people start off by just wanting to know what's possible. So, I just want, if you're watching this and you feel like you're in that camp and you don't know how much money you need to retire off of, just want you to know you're not alone. And if you have questions about what you can actually achieve during retirement, what your savings, your income streams can actually provide you, use that link in the description below. Let's schedule some time with a member of our team. We'd be happy to go through that with you. There's no cost to do that, but at least, my hope is by the end of that exercise, you're going to know exactly what you can accomplish with retirement, and whether that's enough to maintain your lifestyle and continue that throughout retirement. That's going to be up to you and your family. As advisors, we can show you what's possible, but it's up to you to determine whether or not that's enough or not. And so that's the important part of retirement planning that very few people talk about. A lot of people talk about, hey, this is how much most people need. It's just not true. And I've helped hundreds and thousands of people, plan their retirement. Very, very rarely do I see people that know specifically, this is how much money I need and how much is enough. So, all right, let's dig into number 8 here. Every dollar has a purpose. This kind of ties in with the last one. And, the reality is that if you don't have financial goals, and this one was meant for individuals that are younger, that are kind of starting their career or mid-career, and they don't necessarily have those long-term, 20, 30-year financial goals of, hey, I want to retire at, a certain age. I need to live off of X amount, but they're making a good amount of money. And financial goals just aren't something that they've put together yet. It's something that hasn't really crossed their mind. And so when they start thinking about what are financial goals, I always tell them to start thinking about it in terms of, what is the purpose of your money? Start with answering that question. At first, when you're younger, the purpose might be just to maintain your lifestyle. The purpose might be to eventually buy a home. The purpose might be to send your kids to college. As you age, the purpose is eventually to fund your retirement. But all of those, as you start articulating what that purpose is, that's where, those financial goals eventually come from and arise. And that's where you can identify, okay, well, I didn't realize that subconsciously, I am making this money because at some point I want my kids to go to school without leaving school without a bunch of financial debt. And so that's now a financial goal that you can plan for. But at first, if someone were just to ask you in your 20s or 30s, what are your financial goals? My guess is that, and what I've experienced, that most people don't really know, because especially in your 20s and 30s and early 40s, most people aren't thinking 20 or 30 years ahead. They just want to make sure that they're able to raise a family or live life and enjoy life without, really stressing about money. So thinking about those long-term financial goals, the way to start doing that is start identifying what the purpose is for your money. And then from there, working backwards, once you start uncovering that, to determine, is the purpose for this dollar to, to buy an experience and go on a trip or to travel, what are you trying to accomplish? And if you think about it in terms of what's the purpose of your money, that will help you as you go through that experiment. So it's just another way to help you articulate what your financial goals are. All right, so number 9. We got one more after this. And if you're joining us live, I appreciate you being here. Make sure you hit that subscribe button. If you've got any questions or anything, throw it in the chat. I'd love to chat with you if you have questions. And if you want to dig a little deeper, use that link in the description below. Be happy to schedule some time with a member of our team and walk through your individual circumstances. So number 9, investing to get rich quick will usually end poorly. This is something where, especially for young individuals that are just starting out, getting their start in investing, it's easy to see stories of, especially a few years ago, the meme stocks, or some of these stocks that, double or triple in value relatively quickly. That's not the norm. That is the exception to the norm. And so as you're thinking about investing is something that is going to take time to build a portfolio that's going to grow in value over time. Nothing. If you're trying to just, invest to flip your money, in the next week or next 2 weeks, most of the time you're going to take on a lot more risks than you're expecting, and it's not going to end well. I've never, in my experience, and this is just my personal experience, I've never seen anybody who's trying to get rich quick or double their money or, get a very extremely, out of the norm rate of return. I've never seen anybody be able to do that quickly without, it ending poorly. And so I typically see this with, options are a big one, or using, these leverage index funds that are really meant for trading, trying to get leverage on, the market. It's just inherent in additional risk that most of the time isn't needed, but it always feels good. If you're able to, bottom tick something, and next thing you know, you make, a double or a triple in just a quick period of time. Yeah, it feels great, but that's not the norm. And it's important as you're building out your investment portfolio to realize and think about, in the grand scheme of things, over the history of the US stock market, going back to, the 20s and even earlier, the average rate of return, depending on the year you start and year you end, is, anywhere between 9 and 10.5%. So if you're trying to, get 10 times that in the next couple weeks, you're most likely taking on a lot more risk, and it's most likely not going to end well. So as you build out your portfolio, it's always okay to, if you like to have a little bit of just play money on the side, that is going to be that ultra risk, you're going to do some options or whatever you want to do that's going to take a lot of risk. That's fine. And what I always advise people is make sure at least the core of your portfolio is stabilized, is in something that's well diversified, where you're not taking on that type of, mentality of, okay, I need to flip this money and double it in the next, 60, 90, or even, year. The goal is, to establish wealth, to save as much as you can, and then to grow that over time in a risk adjusted way. But if you're just trying to double or, triple your money quickly, I've never really seen that go well. So that's just my opinion. If it's gone well for you, I would love to know exactly what you did, because I'd love to always hear a success story. All right, the last one here. Personal finance is just that. It's personal. And it's important to realize that there's always going to be a textbook answer that might be the right answer, based on an Excel sheet, or, what the professors of finance might say is the way you have to do it. But the reality is, it's still up to you. It's still your goals. And I always think about this in terms of, for me, the big one is Social Security. People, if you Google right now, top, number one retirement mistakes, top retirement mistakes, my guess is you're going to see a bunch of articles, and probably 80% of those articles, it's going to have taking Social Security too early as one of those mistakes. It's just bound to happen. It's everywhere. But the reality is, that's not necessarily a mistake. It's a personal decision. The good thing about, in this case, Social Security, nobody knows if you're right on the decision you make when taking Social Security until we know when you're going to pass away, and no one has that crystal ball. So I use that as an example because there are so many examples just like that. Whether it's, do you pay off your mortgage, before you retire, especially, if let's say you've got a sub 3% mortgage, do you pay that off? Textbooks would probably tell you, no, it's sub 3. Why would you pay that off? It's cheap money at this point. But for somebody, that's in their mind, they've ingrained to themselves, I want to have my mortgage paid off by the time I retire. That just might be a mental hurdle that's going to make them feel so much better going into retirement. So getting that paid off, I always think about that as, what is that mental comfort premium worth? There's a value there. That's not in a textbook. If it's going to make you feel better about your retirement and your finances, it doesn't have to be the right answer in a textbook or, on an Excel sheet. It just has to be the right answer for you. And it does have to make sense in the grand scheme of your long-term financial plan, but it doesn't have to be the same as everybody else. Not everybody has to take Social Security at 70, regardless of what all of the articles online say. You could take it whenever you want. I've seen plenty of people take it at 62 when they always tell you don't take it. I've seen plenty of people do that and not have any issues about running out of money in retirement. And so it's truly a personal decision. So as you go through and you're working towards your financial freedom, always think about that. It's personal to you. And it's important as you're going through this to make sure that, as you're building out your financial plan, incorporate all of that. Make sure you're factoring in. You understand the difference of, in this, as we were talking about with Social Security, the difference of taking it at 62 versus full retirement versus 70. But even if the numbers will tell you that it's better to take it at a certain date, as long as it doesn't ruin your retirement, which I've never seen anybody's retirement ruined based on the date of when they took Social Security, because let's just face it, if your retirement success is going to be based on you taking Social Security at 62 versus or full retirement versus a year or two earlier, you probably should delay retirement anyway. Because if it's that susceptible to a small change like that, maybe delaying might be the best answer for you. So, I appreciate you guys tuning in. I hope this was helpful. Like I mentioned before, we're here every single Tuesday, 4 p.m. Central. If you have any questions, you can feel free to reach out to us at any point. We've got links in the description below. Sign up for our upcoming webinar this Monday with one of the great economists that's going to talk about what's going on in the election. We've got a link in there to schedule some time with a member of our team. We'd be happy to walk through a retirement analysis for you, see if you're on track to your goals, and there's no cost to do that whatsoever. I can promise you one thing: going through that conversation, that exercise, you're going to walk away at least knowing what's possible with your financial life and your retirement. So with that, I appreciate you tuning in. And if you have any questions, be happy to talk to you on a one-off basis. Thanks again, and I will see you all next week.